Well, good morning, everyone, and thank you for joining us. Happy to have you with us. I'm Andrew. This is Sean, and today we're going to go through our peer analytics and balance sheet strategies webinar. And if you've been with us before, you probably know the drill. Where we'll bounce around. We'll talk about what's happening, big picture, capital markets, and the economy. We'll take a deep dive into some trends that we were able to suss out from fourth quarter call reports. And then lastly, we'll wrap things up with some actionable ideas that we can be thinking about on the strategy side. So, this is the part where our friends in New Hampshire, Vermont, and Maine are going to shake their heads in disgust at the southern New England folk. But last week, we were supposed to get a very big snowstorm here in the greater Boston area. And the visual on the left-hand side, there may have been some artistic creativity on my part, but this is what was forecast in terms of the snow drifts. That's the Prudential Tower, which we sit in right here. Schools canceled at 2 p.m. the day before, no milk, bread, or eggs anywhere to be found in the grocery stores. But on the right-hand side is what actually happened. It was kind of a dud. Amongst many takeaways from that experience, I made the connection to predicting weather and predicting interest rates. That it's not as easy as it may seem. So that'll be a common theme that we're reminded of as we go through this presentation in terms of talking about the certainty of knowing what is going to happen. Be careful with the level of conviction on things.
I think your picture there actually has more snow than we got in the city. That's actually more than we got.
Yeah, no, that's when the sun came out, right?
Yeah.
So let's jump right in. So we're going to look at a handful of key indicators that are jumping out to us that I think will tell us a little bit about, taking the pulse of what's happening. And then, Sean will tell us when and by how much rates will drop exactly. No, I'm just kidding. I will do it. Let's go to our first section here. We're going to talk about excess liquidity. And, we've talked many times about watching the level of balances in the reverse repo program with the Fed. And this is important for a couple different reasons, because money market funds have seen explosive growth in their assets under management. And we can see in the bottom panel here first, and the green line, the volume has been trending down pretty consistently since June of last year. And why is that date important? Because that is when the debt ceiling standoff, or the most recent debt ceiling standoff, was resolved. And so that brought Treasury bill supply back into the market. So now these money market funds, rather than having the release valve of dropping their cash at the Fed, they're able to term out if they're so inclined to sop up some of that Treasury supply. And certainly, as we are potentially on the cusp of a pivot to lower rates, to the extent that they have conviction about which way rates are going to go, they're more comfortable about terming out. Now, we look back to the last cycle, and we'll do this a couple times in this presentation, looking at that late 2018 into 2019 period, because there's similarities to where we are right now in terms of hikes into pauses, into an inverted curve. And two noticeable things when we look on the top panel and look at what happened with the RRP in 2017 and 2019. The first is the absolute levels then versus now. It's so much higher now. So back then, you can see in the top panel, the green lines were back and forth between 100 and 300 million before they ultimately declined down to zero. Right now, we're at about 500 million. Where after comfortably cruising above $2 trillion for over a year. So that's first and foremost. But the second thing to point out, and we have it annotated on the top chart here, is that once the RRP effectively went to zero, right, exhausting all that excess liquidity in the marketplace, that's not an automatic sign that cuts are coming right around the corner. So it took over a year for RRP to get exhausted before the first cuts occurred. So, again, this will be a common theme that just because we look at a certain indicator that looks like the hiking cycle is getting long in the tooth, it's not a binary situation where we have cuts and hikes only as options on the table. Pause and a long pause is something that oftentimes gets forgotten. So we talk about the shape of the yield curve as being an indicator as well, and there have been many breathless takes about, oh, the curve is inverted, that means rates are going down, run for the hills, right? But that's not always the case as well. We've talked about this in prior webinars that it can be awfully expensive to bet against the market if your thoughts don't materialize right away. So it's very interesting. The last 3 months we've seen this tug of war between higher for longer and sharp pivots. So right around Halloween of last year, we started to see greater inversion in the yield curve, and we can see that with these three combinations of steepness of the yield curve that I think are most applicable to depository institutions versus the 2 10-year Treasury curve steepness that many times in the financial media you will see. I think these three sets here matter. Can matter the most to depository institutions. So we saw that shift to a greater inversion and expectations of faster and sharper rate cuts. But around the middle of January of this year, things started to cool off a little bit, and we'll get into that in a couple different areas as we go through here. And so some of that euphoria over the sharp rate pivots has tapered a little bit. And we have seen more of this, more of a balancing act between when and by how much short rates may go down in the near term here. So looking more at a true economic indicator versus a market one, let's look at median hourly wage growth in green relative to CPI year-over-year change, the oft referenced inflation gauge. Now, those of you who have seen us before, you know that I like to get on the soapbox about the year-over-year change metrics and what that implies. We're not going to do that today. I will get back on the soapbox maybe at a later date. But for this, the key takeaway here is when the green line is above the blue line, that's when the consumer's feeling good, right? Maybe CPI inflation is going higher. It costs more to live your life. But if you're getting paid more, then it's all relative. And what we saw was in 2022, when inflation spiked up and was all anybody could talk about, wages kind of got dragged along with it. But then as CPI has cooled off back towards more normalized levels, we have seen wage growth continuing to remain high, which is a good thing for the individual consumer. And translating it into bank and credit union world, it creates less need to spend down your savings or your checking account in order to pay your day-to-day, week-to-week bills. And there are some other positive knock-on effects for the economy and for banking balance sheets. But that's the consumer-centric focus. Sean, as it relates to the corporate or commercial customer, is there anything tangentially related here?
Well, I mean, a couple of thoughts really quickly as you're talking about wages relative to inflation here is one is there's sort of a stratification that we've seen between higher income, higher skill employees
Hi, everyone. Apologies for those technical difficulties, but we'll get right back into things.
It would not be a webinar without a technical snafu for us, unfortunately.
You know, it creates a an everyman familiarity, right? You know,
It does. It's just it's funny. But what I was just saying on this is simply that, there's been a stratification of different wage earners and their perception of how their individual well-being and economic well-being has done. And in the 2010s, we had a situation where wealth effect, higher income, higher skilled folks were feeling better about their position. But in 2022 and 2023, there was sort of a reverse of that, where a lot of lower skill, lower wage positions actually started to feel better. There were a lot of folks who made $12 an hour who were suddenly making $18 an hour because of supply and demand constraints. And so that's a dynamic that's been different. And I'm not quite clicking here. Our next slide, when we are able to get it going there we go, is trying to take a look at very long-term expectations on inflation. So this is a look at what the 5-year inflation expectation will be 5 years forward. So it's what will happen over the 5 years from now. So basically 2029 to 2034. So a very long-term expectation. And this is a good way of gauging what the market might be thinking about the Fed's war on inflation. How successful is this going to be, and how successful has it been? And so the Fed has very famously articulated this 2% inflation goal. And so when you see inflation expectations go below 2%, which isn't very frequently, you've seen it a couple of times. Back in the great financial crisis, we had obviously a very significant economic decline, and that resulted in much lower inflation expectations for a short period of time before the full effects of QE and zero interest rate policy kicked in. And then again, during the depths of COVID, when there was a lot of uncertainty and the economy ground to a halt in the spring of 2020, inflation expectations also really very significantly declined. But recently it hasn't spiked too much. As you can see, even though inflation itself spiked, the very long-term expectations didn't spike all that much, but we're still above that 2%. We're about 2.3% today. And so one of the questions is going to be, how does the market really perceive the changes in Fed cuts that could occur? And that's something else I just wanted to highlight here as we think about Federal Reserve actions and Federal Reserve assumptions that start to affect bank balance sheets is the Fed stress test. Again, this is the stress test that the Federal Reserve provides assumptions about to the largest financial institutions in the country. I think this is actually 32 different institutions are subject to managing to the stress test. And so understanding what the Fed is guiding folks to be able to withstand is really important for institutions of any size, even if you're not subject to this, as obviously most of us on this call are not. And so what you see on this is that the Fed stress test actually assumes a 40% drop in CRE and a 36% drop in residential real estate. Again, that's not meant to be predictive. That's not what the Fed is saying is going to occur. But what it is showing is that that's what the level of resiliency that the Fed is really demanding of the largest financial players in the system be prepared for and contemplate and think about managing capital and liquidity to those levels. Again, not predictive, and we're going to show some numbers here about what members have felt on credit as we get into this next section, which is around peer analysis and the call report. As Andrew talked about up front, every quarter we take a look at what happened on the call report. What can we find out about what's happening here in New England, what's happening with our members. We're going to take a look at all different parts of the balance sheet. And we're going to take a look at all different trends that we're seeing with respect to growth, loans, deposits, and credit, as I just talked about. I thought it would be really interesting to have a perspective on what has happened to NIM in this whole cycle to date. I think everybody realized or thought at the beginning we were going to see really increasing NIMs and there would be some pullback. But I suspect that not a lot of folks thought we'd see quite the level of pullback that we've seen, especially on banks. And so here's the full look since Q1 2022. The first hike was in March 2022, and through Q4 of 2023 is what that should read actually. You can see that banks went from 3% to 335 and then down to 280. And the real decline happened in the first half of 2023. That's when you really started to see banks make up for the increases. And what was actually happening there is liability rates started to reprice. Banks started to pay up on deposits. And as you can see on credit unions have been much more moderate in this whole cycle than banks have been. They started at a lower level of NIM, didn't go quite up as much, and haven't gone down back as much, and are actually still a little bit higher than where the cycle began. And something to note about that too is that, again, you didn't see where banks started to really pay up on their deposits. Credit unions haven't paid up on their shares quite as much. And that's been the reason, that's the reason for relative outperformance in credit unions compared to banks in this cycle. One other thing you see here is that, the rate hikes obviously stopped last July. So we've had now a clean quarter with no effects around asset repricing. It's just been purely liability repricing. And something you see here is that NIMs actually only declined 7 basis points versus 6 for banks. And NIMs actually declined more for credit unions in this cycle, indicating that the bleed in NIM is abating, hasn't stopped. And there might be more pain to come actually on credit unions more than banks, because they're starting to catch up on the liability repricing in a way that they hadn't prior. What have our members done? What are the profiles? Because we see, okay, that's the aggregate, that's effectively the weighted average, that prior slide, for all of our members in New England. But the weighted average is not necessarily a look at what every institution has done. Different members have had different experiences throughout this cycle. So what does that look like? So what I wanted to take a look at was to say, how many of our members have actually been liability sensitive and how many have been asset sensitive over this entire cycle? And so the way that I defined that was to say, if you had declines in NIM of more than 20 basis points, that's liability sensitive. And if you had increases in NIM of more than 20 basis points, that's asset sensitive. And if it's in between, you're within 20 basis points of where you started, moderate. And so what has happened here? Again, you see that credit unions relative to banks have been more asset sensitive, no surprise, given what we saw on the prior slide on NIM. And it's actually more than 50% of banks at this point have demonstrated liability sensitivity. And that's been growing the past couple quarters. I think last quarter was about 51 or 52 when I looked at it. This quarter we're up to about 56%. Just the opposite for credit unions. More than half of credit unions have actually been asset sensitive. Again, that's starting to decline as we continue to have this slow bleed in NIM. But this does give some perspective, I think, to folks out there about if you're feeling liability sensitive, especially as a bank, you're not alone. You can see also too that about 20% of our members are moderate, have kind of stayed within a pretty tight range throughout the cycle.
Now, just I'll go back to that slide for a second. If we had asked members 2 years ago to self-identify, where do you think you fall in those 3 categories? Would there be, we don't think that there would be many people in those first 2 buckets relative to what actually happened over the last 2 years.
Yeah,
right?
I think that's exactly right. I think a lot of folks thought they were more asset sensitive than they're proving to be. And one thing that I do wonder about as we think about lessons to be learned for a future cycle someday is how much the speed of this cycle influenced these numbers. Right. Because the speed was so dramatic that I think it forced a lot of liability pricing. So let's take a look. So margins have declined. More folks have been liability sensitive than they thought they were. Has volume been able to make up for the difference? So if you you could grow your way out of some of the margin problems potentially. So here's a look at what happened to our member banks. And this is all these numbers for member banks are below $100 billion in assets for a member bank. So it's not unduly influenced by very large members. And what you can see here is that actually bank NII for the year of 2023, this is just the year, not the whole cycle, just 2023, NII is actually down. And it was down because liability repricing has offset asset repricing to the tune of 2 to 1 about. And that more than made up for the change in asset volumes that actually had growth. So profits actually down at most of our member banks. And then what about on credit unions? Basically held par. For 2023, basically held serve. And what you see here too, again, from comparing to the prior slide there, where liability rates for banks was $1.2 billion of extra expense compared to only $665 million of extra interest income associated with assets. On credit unions, the pay up on the shares hasn't been anywhere near as dramatic compared to banks. And so you see that the NIM is pretty tight and the growth that you see in credit unions actually makes up for it. So you end up with a higher overall NII. Something else I'll just really quickly highlight on this phenomenon compared to something that we've talked about in prior webinars is that what was the single biggest driver for those banks that had the most liability sensitive? It was loans to client deposits. So the loans were pushing the deposits, which caused the overall margin to decline. That's the pattern that you see. Higher loans to client deposits drives liability pricing higher to try to get more funding, and then that pushes the overall margin down more than probably you might expect.
So let's take a little bit of a look at some of the balance sheet components. So the first thing we'll talk about is deposit growth, and we'll look at it in the extremes, or in our parlance, a barbell, right? We'll look at who was able to grow deposits more than 10%, which sounds like an impossible task in this climate. And then at the same time, we'll look at what percentage of members had negative deposit growth quarter over quarter. And if you're in that boat of having negative deposit growth, one of our goals here is to tell you that you're not alone, as you can see from some of these numbers. So first on the outperformers, the greater than 10%. So 12% of credit unions and 15% of banks saw exceptional growth last quarter. And some of it was broker deposits, not all of it. Some of it was money flowing into term deposits, but not all of it. So I think what it really highlights is that there are some macro headwinds right now. Nobody is really denying that. But to be able to just show up and have deposits fall out of the sky is not the environment that we're in. So really, the onus is on your market, your business strategy, your verticals. What are you doing, and executing upon successfully to be able to bring in deposits? So on the flip side, on the right-hand side, we can see 55% of banks and 58% of credit unions saw negative deposit growth. So there are the macro headwinds coming in at 50 miles an hour that make it challenging just for the average institution to be able to forget eclipsing that a mid-single-digit hurdle like most of us will put on probably during budget season. But we're just talking about positive versus negative here. So more than half have experienced that. Let's switch to loan growth. And as a reminder, if anybody has any questions of anything along the way or anything in general, we're happy to field it as we go. On the loan growth side, again, we look at the percentage of members who are growing quarter over quarter by each of these various segments. So when we look at the percentage of members, it's important to, two ways to think about it is that 40 to 60% range is kind of where you're usually going to be. And we're looking for the long-term directional trends that will tell us something as well. So on the auto side, bottom left, for credit unions, we can see things have been gradually declining over the last handful of quarters. And many of you remember in 2022, as some of the supply chain issues alleviated back then, that the activity really has been gangbusters and is normalizing, is how I would put it now. One interesting thing there is to look at that the back and forth between when used and new autos go higher or lower, and that may tell you something about the health of the consumer, right? In periods where people are feeling good, new autos are above, and people are pulling back a little bit. Maybe it's used autos where we're seeing the demand for. Moving to the bottom right, banks with their commercial activity. Multifamily is steady as she goes, as one might expect. CRE, similar to the credit unions and autos, it has been coming back after really very, very strong levels in 2022, but still what we would characterize as a positive levels of growth there. Now on the CRE side, certainly there's a lot of noise and news right now about the fear and chaos that I know folks are seeing on the commercial real estate side. But I think it's important to remember for most community depository institutions, the type of commercial lending that they're doing is not Class A office space in major metropolitan areas, right? It's much more nuanced than that. So when there's the breathless headlines about the world's going to end and CRE is going to be the cause of it, as it relates to bank and credit union balance sheets, a little. Like we said, a little nuance and a little deeper understanding is probably warranted. Up top on the residential lending side, this has been one of the more fascinating things for us to observe, right? With the path of interest rates, it's been, to call it a challenging purchase market is probably underselling it, right? But we have seen balance sheet loans, residential loans growing, more so, much more so at banks than credit unions. And, I have a couple theories as to why that may be. The first is, I think, it might be that banks have more of a robust product set as it relates to ARMs and things like that, where you can get the rate down a little bit versus the conventional mortgage rate. And the second part is, I think it's the NAV test for credit unions. That means the long-term asset interest rate risk, certainly in this part of the cycle where deposit gathering has been challenging, the shift to term deposits, we'll see that in a little bit. I think credit unions generally probably more sensitive to the idea of putting fixed rate duration, long-term fixed rate duration on the books. So I had mentioned term deposits and the shift there. So this is again another fascinating thing that we're seeing, much like when Sean was looking at the NIM performance, that really banks and credit unions experiencing similar things, but there are more differences really than you might expect in this part of the cycle. And what we see, and this is looking at term deposits as a percentage of the total deposit book, and credit, and as we might expect in this higher rate environment, more deposits, more term deposits are coming on the books, and there's certainly a shift from the non-maturity side. But if you see where credit unions are today, both or from the 25th percentile to the median to the 75th percentile, they're about 2 to 4% above where they were. Again, let's call back to the 2019 cycle. We're 2 to 4% higher as a percentage of the total deposit book than we were where we were in 2019. For banks, we're about 3 to 5% lower in terms of the CD concentration, and that'll segue into trying to figure out some of the explanations there. So I think it's probably intuitive for most to say, if you have a greater reliance on term deposits, well then you're going to have higher interest cost, right? That's one of the things that we think we all know about banking. And so when we looked at the combination of those two factors, right, term deposit concentration versus cost of interest-bearing deposits. So it's not cost of funds. We're removing wholesale funding. We're not even looking at cost of deposits to which will get non-maturity, non-interest-bearing accounts in the mix. So just interest-bearing deposits. And back at the end of 2021, very similar correlation for banks and credit unions, 0.7 approximately, where if you had term deposits, that meant you had higher interest costs. What's happened now as this cycle has moved on and rates have moved higher, and you can kind of see it by the shape of the blobs there on the scatter plot, is that credit unions have maintained and actually improved that relationship, right? Where rates have gone up, but so has and so does the concentration on CDs. With banks, it's a little more over the place, and that's borne out by the lower correlation that we're seeing. And I think the biggest explanation here is it's the customer base. When you think about the credit unions, looking at in aggregate at the credit unions, it really is a very nice proxy for the retail customer. We don't have the granularity just by looking at call reports that many of you do and slicing and dicing your deposit portfolios every possible way. But when we look at particularly on the left-hand side and look at the experience that banks have and seeing that drift moving to the right in terms of higher cost of interest-bearing deposits and not necessarily perfectly correlating to the shift in term deposits. So that tells me, though, those commercial depositors who are probably not the biggest fans of the term deposits, that under the hood, there's an awful lot of exception pricing and tiered pricing that some of those money market accounts are receiving. So maybe the term deposits aren't growing, but it's really, so when you get down to strategies to what do we do in the deposit portfolio, that it's knowing it inside and out and knowing what you have to do to meet the needs of each customer that you have to keep them there at a cost that makes sense for you in your balance sheet, right? And Sean mentioned before, you know, the loan to client deposits as being something very important, that if you're lending, then maybe that gives you a little capacity to go out and gather deposits even at a higher rate. So since we've had that exceptional loan growth, you know, that's a next level analysis that maybe we can do and see those folks who have really moved far to the right on that chart. I would suspect that those are the ones who have seen the phenomenal loan demand. So let's look at the investment portfolio, and you know, the move in interest rates this last quarter was a good thing for that anchor around our neck, which is the unrealized loss in the investment portfolio. So it's somewhere between 2.5% to 4% improvement in terms of the median unrealized gain that banks and credit unions are currently exposed to. And now that's you know, when you think about the 5-year Treasury, use that as a proxy, moved about 80 basis points from 9.30 to 12.31. That gets you in that 4% range when you do that back of the napkin duration math, but it's probably a little light. So what does come to mind, and this is, and after digging through and analyzing the bar chart on the right, we have seen an improvement in the quarter-over-quarter change in yields the last few quarters, which my initial theory going back a couple quarters ago was that we were going to see that slow down because of the tightening of liquidity and folks not just necessarily growing the investment portfolio, but even replacing the cash flows. So whatever meager cash flows are coming off from the 1.5% you know, MBS that you may have bought at low rates in 2021. Well, if you're just maintaining a constant level, you're going back in at 5.25%, 5.5%. So that's going to lead to a little bit of a bump, all else equal. But I think you know, there has been some balance sheet flexibility and certainly liquidity and capital at our premium, so it's difficult. But to the extent that you can put things back in at much higher rates, much wider spreads, Sean has talked about in past instances about putting on positive convexity on the asset side of the balance sheet, which can pay dividends if and when we do see a turn in the rate cycle. So I think that is something that you know, in spots we have been seeing occur across the district. So let's talk about credit stress. So here we're looking at reserves to non-performing assets. And you know, there's two ways we can tackle this, right? We can increase the numerator or we can keep the denominator flat. And you know, this is looking at all quarters going back to 2019 and breaking it out by the median, but also those who are more or less conservative on their approach to, you know, to these coverage ratios. And I think what we've seen in recent quarters is that, you know, whether you're conservative or aggressive or right in the middle, you know, the coverage ratio has come down a little bit in prior quarters, and that's okay. And it's not necessarily, well, non-performing assets have started to tick up a little bit, probably not to troubling type ranges. I think part of that was we were so well reserved in 2020 and 2021, waiting for that credit storm that never really came. And then with the implementation of CECL, reserves were in a good place, and we weren't really seeing assets go bad. But you know, the last thing I'll point out about credit here is certainly over the last call it 11 months, liquidity risk and interest rate risk as it relates to banking industry health has gotten a lot of press, right? You know, especially going back to March of last year. But many of us who've been around for a bit know that usually it's credit that is at the scene of the crime. So you know, certainly no one is forgetting about credit. You know, put aside the, you know, the CRE, you know, conversation we just had a few slides ago. But, you know, all in all, I think credit from both the numerator and denominator side of things is in a pretty healthy point.
Yeah, whoops. And if we think about this, you know, are folks getting paid? Are folks getting paid to take on that credit risk and to assume those deposit costs? So I want to take a look at what is the distribution of loan yields across member banks and credit unions. Perhaps surprising, at least surprising to me when at first blush, is that member banks actually have slightly lower loan yields than credit unions, though both are right at about 5%. And here you can see the distribution. It's to no surprise an S distribution where there is a small percentage of folks very much at the top of the distribution with much higher loan yields than other places, and a small percentage of folks with much lower loan yields at the other end of the distribution. But again, you can kind of see where folks are, and what you see here is that middle 50 percentile, that middle 50% of institutions are in the high 4s to the low 5s in overall loan yield. So a good perspective again on how your institution might be doing compared to other institutions is to see how have you performed on asset sensitivity and your loan yield relative to other folks. So how do we use this? How do we use all of this? So we talked about all this peer analysis and peer data. We talked about the macroeconomic backdrop. I'll talk a little bit here about margin headwinds before Andrew's going to talk about how you can actually actionably take advantage of this situation with our inverted yield curve and given the margin pressures that are out there. And to that point, I want to talk about, again, a little bit more about the margin pressure and to try to think about a perspective on how much more is there to go. So this is a slide that I've shown in the past, which is a look at what happened in the 2004 to 2006 cycle, and just beyond it, as the pause happened in 2007, what happened to interest rates and what happened to deposit expenses at our member institutions, our member banks in this particular instance. If you can remember that cycle, Fed funds went from 1% to 5.25% over the course of 2 years. In this cycle, we went from 25 basis points to 550 over just over a year, about 15 months. So a much faster cycle to the point that we raised earlier, but pretty similar in coming off a very low level of rates for a period of a couple of years to a much higher level over the course of a relatively short time frame. Might be a good precedent for us to think about where deposit expenses could shake out. And in that cycle, at the peak of the cycle, it was during the pause, an extended pause, where deposit rates topped out just below 3%, about 2.9% off a base of 1.18%. And again, like the last cycle, this time deposit rates were actually slightly higher than where the Fed funds rate where it started, and then peaked or seemed to be peaking, getting to a place significantly below where they were, to no surprise. But also of note here is that deposit rates didn't come down quite as fast as Fed funds came down. So something else to think about as we go through the cycle here. And so if we think about that beta, what has happened in that prior cycle and what could happen in this cycle, in that prior cycle, the effective beta for banks was 41%, just over 40%. I think a lot of folks in the industry have recognized the fact that a lot of banks model about 40% effective betas over the course of the cycle. That's what they saw in 2004 to 2007. What has happened so far? If we just look at the bold numbers at the bottom there between banks and credit unions in this cycle to date, banks are at about 34% and credit unions are at about 24%. And so if we do the math, if we apply that that prior beta to that 2004 to 2006-07 cycle and apply it to this cycle, that means there might be another 37 basis points of potential exposure out there. And that doesn't mean it's necessarily going to happen, but I think that starts to give a ballpark of how much more deposit rates could bleed over the next couple quarters while we're in this pause waiting for the Fed to act, and nobody's quite sure when that next shoe will drop on the rate cut. There might be another 37 basis points of deposit expense exposure out there. And to Andrew's point too, a little bit earlier, it's hard to you can't really roll out of bed and make a 3% margin right now. And why? Because you're funding probably in the 5s on the margin through CD issuance, through borrowing from the home loan or other wholesale sources. Funding is probably in the 5s at this point. And then loan yields are, because of the inverted curve, largely nowhere near that 3% extra spread above that. So here we take a look at just different indices and different spreads across those indices. If we took a look at something like SOFR plus 200 or 250, you're in the mid 7s. If you're taking a look at 10-year treasuries plus 250, you're in the high 6s. If you're taking a look at a 5-year home loan advance plus 225, you're in the high 6s. So if you're funding in the 5s on the margin and you're putting on assets in the high 6s and mid 7s, obviously that's going to be not accretive to margin on day one, and identifies the importance of putting on some of that positive convexity that Andrew just talked about on the loan side.
Well, with that terribly uplifting note, let's, what can we do, right? So Sean mentioned the yield curve is inverted. And one refrain we hear from a lot of folks is, well, we're staying short on our funding because rates are going to go down. Well, there's no free lunches in the yield curve. It's we can do the math all day long, and the refrain that should be amended to say we're staying short on our funding because we believe that rates will go down more than what is currently priced into the market, right? So, the shape of the yield curve effectively prices in the future expectation of short rates. So without going on too long of a either speech or rant about, yield curve pricing and implied rates and whatnot. So, let's look at where rates were in mid-January, right? When we talked about that, the short pivot had really kind of picked up steam versus now where things have softened a little bit. So the 1-year rate hit 476 on January 12th, a 1-year classic advance. You can get to that total interest cost of 1 year of 476 two ways. Borrow the easy way for 1 year for 476, or roll short-term advances and based off of what is implied into the current market rate. So 3 months, borrow again in 3 months, borrowing again 3 months, and then do it again for a fourth period. So we can find out what that rate going forward is. So if you look along the bar chart on the right-hand side, back when the 1-year rate was at 476, that was implying that the 3-month rate 9 months from now, so that's months 10, 11, and 12, is implied at 401. So that's approximately 150 basis points lower than where we were at that time. So if you're of the mind and your balance sheet is positioned to take advantage of that and say, you know what, I don't think that we're going to see that level of rate decline over that period, or it's complementary to my balance sheet to hedge against that, then rather than rolling the short term, incrementally extending out, can have some value. We've talked about a lot in the past about how the HLB option, the puttable advances, have been very attractive and very popular with our members to create some cost savings, certainly in this challenging margin environment. But a wrinkle to that you may or may not have noticed, we noticed, Dan Redmond noticed, and I'd be curious to see if anybody else noticed, is in our daily rate emails, we often put rate indications out there for a variety of different structures to give you a feel for, it would be overkill if we put all 56 structures in there every single day. So we put a sampling of 3 or 10 in there. But recently we've seen a lot of value in some of the shorter maturity finals, so namely 12-month and 18-month. Now, the cost savings versus the classic advance curve are not going to be the same as the 3 and 5 year because you get more bang for your buck there. But it's a trade-off, right, between the potential extension risk that if rates do pivot sharply to a lower rate environment, that you have that shorter maturity that will allow the maturity to naturally roll off and not extend. And then you can be in that advantageous position of, in a lower rate environment, a environment more conducive to gathering and retaining cost effective deposits, then gladly take that wholesale funding, pay it off, and grow that deposit portfolio back up. So you can see some of the cost savings here for some of those shorter maturities. So I think that if you're rolling short-term advances, you're well into the mid-5s, that there's some opportunity here to peel off some of that piece and maybe take a look at some of these shorter structures. You think we'd have a 50% chance, right, between up or down? But
it's a confusing clicker.
We're batting like
it's a really confusing
200 here. So to that end of putting on some funding that's liquidity metric friendly, the rub is always that, okay, well, maybe I like the idea of extending out to 1 year, but what happens if I get a flood of deposits or my asset cash flows accelerate? Well, I would argue that for asset cash flows to accelerate, you probably need 300 basis points of rally, maybe even more, right? So the likelihood of that happening is probably pretty low. Unexpected deposit inflows, your mileage may vary, but that's probably a greater probability than the asset cash flows. But from a conservative standpoint, if you're saying, well, I want to extend my funding, but I don't want to get caught with too much wholesale funding, well, then we have some advanced products where you control, the member controls the option to pay down the advance. So if you're rolling short-term advances like a 3-month classic advance, for example, Our DNA floater, our discount note auction floater advance, has recently been pricing, and has been for a while, a very similar all-in rate. You can see it. In fact, it was 1 basis point cheaper when I priced it out the other day. But on the right-hand side is really where the value is, because it is a 12-month advance. You have the benefit of from the liquidity metrics of saying this is a 12-month funding. It reprices every 3 months. But the beauty of this advance is that every time it reprices, in this case 3 months, we do have a 1-month version as well. You have the ability to prepay the advance with no fee. So this creates the opportunity that you can have liquidity metric friendly funding, but still retain that flexibility to recalibrate the amount of wholesale funding you have. Oh, got it on the last slide here. All right. So another idea that I think is of value, it's not on the advance side, it's on the mortgage purchase side. So many of you who are PFIs are maybe familiar with our MPF program, where we buy mortgage loans from members. And aside from current production flow that you may look to immediately sell and take a gain on, we also have the ability to buy season loans. And however you define season, it could be something you've portfolio for a couple months, or it's been on the books for years. But there's a couple different rate environments that we've seen in the last couple of years. So certainly there was the high volume at very low rates in 2020 and 2021. Those 3%, as many had so much excess liquidity that they were putting these on the books, and now they're underwater. So to think about selling these, it's almost like the investment loss trade, that this is not something that happens in the silo of the mortgage group or Treasury, for example. That this is, you got to get everybody on board. This is ALCO, this is the board. You got to look at your capital and earnings position, and your ability to absorb the income statement noise. So that's as you looked at ways to bolster your liquidity, that's certainly an option. But aside from that, those selling loans at deep discounts, there could be opportunity as well in more recent production, right? A lot of, we mentioned before, a lot of activity has flowed towards adjustable rate products, but to the extent that there were fixed rate loans being portfolioed, in 22 and 2023, if you have something that maybe you top ticked where rates were, so it's something mid to high sevens possibly, maybe there's a little bit of a gain on, more of a gain on sale than you would with the current flow pricing. And the other thing is maybe it's slightly underwater, where you may target a gain on sale of 102, based off of where rates are. But let's just say the going market rate is 7% today. You have a 6 1/4 loan that may be at par. I said, well, why would I sell a loan at par and make no money? Well, you've earned the carry for the period that you've held it on the books. But it's not just about the sale on that loan. It's about the use of the precious capital and liquidity that you have. So to the extent that you have other things and other initiatives that may be better uses of that capital and liquidity, whether it's shrinking the balance sheet, other lending opportunities at wider spreads in different buckets, that situation where you can sell that loan and not take an income statement loss and redeploy into more targeted areas, that may be an opportunity and an idea. So this is one of my favorite ideas. There's more nuance and more things to talk about, more than we can get into right here. But if you have any questions, reach out to myself, your relationship manager, or one of our MPF representatives. We'd be happy to walk you through and discuss all that we may need to do there. So that brings us to the end. Thank you everybody again for your participation. Hopefully you found something of value here, and and if you were in that group with 60% negative deposit growth, hopefully you found took some solace in that you're not alone, and we're all rolling up our sleeves and doing what we can to manage our way through this challenging environment for banks and credit unions. So with that, we'll sign off, and thank you very much, everyone.
Thank you.